Okay, so let's get back to the meat of the Porter analysis. Although that information with respect to barriers to entry is really important, you need to go over and review those, come up with some of your own. So, threat of substitute. Okay, how likely is it that substitutes are going to enter this particular industry? Hmm. Now, why is that important? Well, because as we said before, that if the threat of substitute is large, okay, then the attractiveness of this industry goes down because there could be at any time an influx of entrants, which would then lower the profitability of the industry. And this threat of substitute is impacted by, as we mentioned, switching costs, okay, buyer inclination to substitute, price performance trade-off for substitute. What does that mean? That means that there is a point in terms of a ratio between price and performance that substitutes become competitive, where substitutes become competitive. This inclination to substitute from the buyers is also an interesting one as well. How likely is it that buyers in this particular industry will substitute? In some industries, for example, people are very loyal. In other industries, they're less loyal and more likely to try substitutes. Oftentimes, in this market, they're dissatisfied with the current competitors' offerings. That might be a good signal that this is a good market for you to enter. Because if they're dissatisfied, if they're likely to substitute, then maybe you can shake a few loose to test your product. Power of suppliers. The thought being, again, if your suppliers have lots of power, that has an impact on your costs, which has an impact on your profitability. So, if the concentration of suppliers is small, that points to power for suppliers. Importance of volume to suppliers. If the supplier really needs lots of volume, that then means that he or she probably has less power. Differentiation of inputs. Okay, whenever differentiation comes in, okay, that leads to power, because if a supplier is supplying a generic product, a product that is undifferentiated, then you can buy that product from anybody, and that reduces the power of the supplier. I'm not going to go through all of these. Threat of forward integration. What does that mean? Okay, remember the discussion of the value chain from raw material to end user? Okay, so a fully integrated company is one that controls the entire value chain from raw material to end user. Forward integration means you're moving closer in the value chain to the end user. For example, if you were an oil wholesaler, an oil and gas wholesaler, and you moved into selling gas from a gas station to consumers, you have forwardly integrated. So if a wholesaler is likely to integrate forward, if he or she thinks they are getting a raw deal or that more profits can be made by integrating, that gives the power of suppliers a boost. Do you understand that? Let me say that again. That if there's a threat for forward integration, then the power of suppliers is higher. Okay? Power of buyers. So in this case, we're the seller. If the power of buyers are high, That has an impact on our profitability, has an impact on our ability to adjust our prices. So in this particular case, this is not a good situation. So power of buyers can come to play in a number of different ways. Buyer information, for example, if a buyer has lots of information, he or she may be able to better negotiate prices. If there's a threat to backwards integration, if it's possible that the buyer might move backwards in the value chain and do the same business that you're doing, then that reduces your power. You can't negotiate. If I say, look, if I'm in the oil and we're in the oil and gas business, okay, and we're in the gas retail business, we have a gas chain, and we think that our wholesaler is charging us too much money. Our wholesaler could say, you know what, we're not going to sell anymore to you. What we're going to do is we're going to start selling directly to customers and start our own chain. Now, you don't want that competition, okay, especially from someone who has a guaranteed source of supply. So that reduces your ability to negotiate, increases the power of the buyer. Buyer concentration. If buyers are very highly concentrated, and mean they're not very dispersed, that gives buyers additional power. If there's substitutes available, then the buyer doesn't have to buy our product. They can buy another product that's related, that does the job. That again reduces our power. It makes the industry less attractive. Degree of rivalry. What's the situation, the competitive environment within this industry? And things that have an impact on this degree of rivalry are exit barriers. Now, we talked about entry barriers. You know, how hard is it to get in? But there are also exit barriers. How hard is it to get out? Businesses that have significant capital investments, for example, have high exit barriers. It's hard to get out because it's very expensive, for example. Industry growth rate. How does that impact rivalry? If an industry that's not growing very fast, or an industry that's not growing at all, or collapsing, you would expect that the rivalry would be more intense. Let's see here. Product differences. In an environment where products are quite different, the rivalry is less intense. Products that are very similar, rivalry is going to be much greater. So the degree of rivalry has an impact on the attractiveness of the particular industry. So let's go back here and look at this. Threat of entrance, bargaining power of buyers, bargaining power of suppliers, and threat of substitutes interacting with the rivalry of existing firms. Okay, so let's look at wheat being a wheat farmer entering the wheat business. Okay, so bargaining power of suppliers. There are no real suppliers except the people who are selling grain seed. Okay, so the bargaining power of suppliers is very low. Threat of potential entrants. Entrants can enter this market. There's barriers to entry are not very high. Okay, but there's no rush to enter the wheat growing business. Bargaining power of buyers. Okay, the bargaining power of buyers of wheat is actually relatively high, in that wheat is determined by supply and demand, but the buyers for raw wheat are relatively concentrated, so we as wheat farmers have very little impact on the price. Substitute. The threat of substitute in terms of different types of wheat is not very high, but since we're selling an undifferentiated product, they could buy wheat from somebody else and it wouldn't impact them at all. It would impact us quite a bit. Rivalry among existing firms. Since the price doesn't vary very much, okay, the rivalry among existing farmers, okay, is relatively intense. Given all those things, the wheat business is probably not going to be one that is of high profit. In fact, it isn't. But let's look at the pharmaceuticals, for example. Okay, bargaining power of suppliers. The suppliers are raw materials, commodities. So the bargaining suppliers very low. Potential entrants. Okay, while there might be a lot of people who want to get into pharmaceutical business, it costs hundreds and millions and billions of dollars to be a global player in pharmaceuticals. So the threat of entrance is very low. Bargaining power of buyers. Well, we're making drugs. And if you have an ailment, you kind of have to use this drug. So the bargaining power of buyers, is very low. Related to that is threat of substitute. While there's certainly substitutes among drugs, if this is the best drug, there's not a lot of substitute. And rivalry among existing firms. There is significant rivalry among existing firms at different points of time in the product life cycle. But since most of these drugs, at least during the patent period, are patented, you have a monopoly or temporary monopoly for that particular drug. So there's no rivalry among firms. So all of this leads to a situation where the industry is very stable and the profitability is very high. And it stays that way because of these 5 forces. Okay. One of the problems with the 5 forces analysis is this. If we're doing an analysis before we enter a particular industry, that might be a good thing because we could say, this is not a good industry, let's pick another. But what if we're already in the industry and we do the analysis and determine that, this is not a good industry? We're kind of screwed. That's one problem. Second is this analysis is very static. Also, again, he's looking at the industry as the major determinant of profitability, and subsequent research has shown that it's the strategic choices of the managers that far outweigh the industry structure. That good managers will run good companies, and their good decisions will lead to profitability, not just because they're in an industry. There are people making lots of money in so-called bad industries, and there are people who are losing lots of money in so-called good industries. So it really is about the strategic choices of the management. Be that as it may, out of the Porter analysis came these generic strategies. Now, these generic strategies really are generic, and while he gets credit for creating them, he didn't create these strategies at all, but he helped put a name on them. So there are 3 or 4, depending upon how you want to categorize them. Okay, and I will pick these up in the next lecture.